Welcome to another episode of ETF 360. I'm Tom Lydon with ETF Trends, and joining me today is Jeff Weniger, who's head of equity strategy at Wisdomtree. Jeff, great seeing you.
Thanks, Tom.
Hey, Jeff, there's been a bit of a rotation lately. After growth beaten up on value for years, it seems like value's coming back to life. Tell us about it.
Yeah, and it's only been, 5 months of this after, depending on your starting point, Tom. I kid you not, you're going back 14 or 15 years, where for the most part, it was all growth. Aside from 6 months a year, 12 months there, I mean, you go back to before the financial crisis, whether you're looking at S&P 500 growth relative value or the Russell indices or whatever you may be looking at, it's been for many of our entire, I'm mid-career, Tom. And basically my whole
I
career has
know.
been growth crushing value. And I mean, I think you can maybe even pinpoint a specific date here. It was November 19th of 21 when the NASDAQ peaked. I mean, you got a little bit of a rally going in the NASDAQ here, but it's been a lot of trouble in growth and values looking like the haven.
Well, the pendulum's swinging back for sure, and everything reverts back to the mean. But like you said, it's been a tough period for value. But now, talk a little bit about why things are working for value now. I mean, there's a lot of money in motion for sure. There's concerns about rising rates, inflation, higher valuations, especially in U.S. stocks. What are
Yeah.
some of the things that you're talking to advisors about?
Yeah, and I think you just nailed it with the higher rates. It used to be that higher rates would hurt the dividend type companies. But now that notion has seemingly changed. Higher rates means trouble for distant cash flow growth companies. And our dividend mandates, like DLN, for example, which is a classic at this point, Tom, we're 15 years old on DLN, which is Wisdomtree large cap dividend. That stuff has been saving ground. You got black ink on year-to-date performance on these types of concepts, which is complete opposite of some of the carnage that you've seen in groups like Unprofitable Tech, various NASDAQ trackers, and so on.
Yeah, and Jeff, where do you think the money's coming from? Is it from advisors or investors who were over allocated in growth, especially large cap growth? Or is it, the fact that you look at the 60-40, a lot of advisors admittedly are saying, you know what, I'm going 70-30, I'm going 80-20, I'm moving away from the ag, and I don't care, but I'm more concerned about the fixed income marketplace now than I am the equity space. And boy, if I can get in some conservative stocks that are kicking off decent dividends, that's it for me.
Yeah, dividends and shareholder yield are two of the main concepts that we've been talking about at Wisdomtree. And yeah, look, even if you're in a core fund, even if you're an S&P tracker or something like that, you've just naturally drifted growthy through time in that you got engaged in those trackers 5 or 10 years ago. It's been nothing but growth stocks. They start to tilt the profile of the market. And next thing you know, you wake up, it's 2021, 2022, and you don't have the same value exposure that you may have had in an S&P 500 of 2010 or 2015. And that's part of the equation. Now, in terms of what they've been doing relative to bonds, there is some of that freak out going right now. They're freaked about stocks and they're freaked about bonds because both have had a rough go at the last quarter or so. And it's one of these situations where if you look at the COVID freak out, you didn't buy up value in that COVID crash. It was all about that growth stuff. Hyper growth was what held up in the COVID crash. But here in this little stealth, quiet bear market underneath the surface here, the last 4 or 5 months, it's been all about just quietly accumulating staples and utilities and these types of things that populate dividend indices.
Yeah, and what you point out, volatility is one of the major
Yeah.
concerns for investors and advisors right now. And yes, are you going to see volatility on the fixed income side? Definitely, if the Fed does what it says it's going to do. And
Yeah.
then is there potential greater volatility in growth stocks? Yeah, definitely for sure if they're going to hike interest rates. But boy, being able to look at value stocks in current day valuations and really the chance that we're not going to see major drawdowns in those areas, even if the moon and the stars align for all the bad things out there, right?
Well, seemingly is the play. I mean, if you look at one of the concepts we have, aside from just straight dividend screens, the shareholder yield screens that we have in WTV. Shareholder yield is the sum of your buyback yield plus your dividend yield. And on that one, we're north of 8. So you almost have this captive buyer in the marketplace where if there's a real waterfall in the stock market to the downside, you have these companies that are out there buying hundreds of billions of dollars worth of equity in a buyback type concepts. That's WTV right there. And that's where we're starting to see a lot of this stuff holding up, where the conversations are going there. Like, hey, priors, tell us about your growth fund. That conversation isn't happening so much anymore. It's tell us about your consistent buyback companies. And it's because when you look back at the last 50 years at the real ugly markets, maybe the Fed will give us one of those markets if they keep hiking like this. The
Yeah.
ones that have been real trouble zones are the share diluters. And that's NASDAQ stuff. That's 500 growth stuff. So we'll see how that goes.
Okay. Give us those tickers again. Again, you said WTV, correct?
WTV, yeah, we launched that one before the global financial crisis.
All
So,
right.
so that one's a generation old. The other one's DLN. DLN's the dividend screen one, and that's a 5-star fund. WTV's a 4-star fund. So we're at this cool point here at Wisdomtree where we're no longer this company with brand new funds. The funds are now 15 years old. We got track records under our belt. So it's a really cool situation and very interesting setup if this is more than just 5 months of value, if it's 5 years of value or 10 years. And that's what we think. That's the base case. So
Yeah.
it's going to be a good 2020s for us.
The pendulum swings, and that's it, because the current trend is not something that's always sustainable. Hey, Jeff, you guys do a great job over there. It's great getting time with you. Thank you, and I look forward to seeing you in person.
All right, Tom, take it easy, all right?
Take care.